Hi everyone, Kessler Sleemy here, the mortgage broker and property investor. I wanted to give you a mortgage market update for January. There's been a lot going on in the market over the last couple of months, so it's good to just let everybody know where we are. There's a lot of positive news just now as well, so obviously a lot of negative media going on in the market. So hopefully I can give you some good news in regards to mortgages. Maybe just a bit of a background on myself before we start. I own the business Freedom Financial. We specialize in helping property investors buy and grow their portfolios. I too am a property investor, so work in the same shoes as you guys. Got decent sized portfolio between me and my wife. We've got properties in our personal names, limited company, and also have a holiday let as well. Mainly operates on the buy, refurbish, refinance strategy. Right, okay, guys. So just give you a mortgage market update for January and to give you an idea of what's happening. So in December, the Bank of England did put the base rate up again to 3.5% now. So it was a 0.5% increase. At the moment, they're expecting the base rate to go as high as 4.5%. That's kind of their outlook. So bear that in mind when you're looking at mortgage products. But off the back of this increase, we didn't see any products change. So I suppose what that tells us is that the lenders were already factoring in this increase. And actually, mortgage products have actually decreased over the last month. So they started to come down. Some products went down in December, but the majority of products have started to come down in January as the lenders have started lending again into the new year. Um, One of the main reasons for this is that a lot of the lenders had hit their targets for lending last year because last year had been such a buoyant year in the property market. And a lot of lenders have quite ambitious targets to meet for this year as well for lending. And with the mortgage market slowing down a little bit too, especially for purchases, they're starting to become a bit more competitive when it comes to prices. I also think that they're going to be a bit more flexible when it comes to criteria too. So overall, good news. For us, for our clients as well, if we've got purchases going through, we're just keeping an eye on rates because some of the rates are dropping. A lot of lenders allowing us to move on to that better product even after submission. But yes, overall, it's good news for us just now. The mortgage stress test, this was an issue, especially kind of a couple of months ago after the Kwasi Kwarteng mini budget, and interest rates went sky high. The problem was that the lenders were then needing to stress test the mortgages at a much higher rate than there was previously. Previously, typically lenders would stress test their mortgages at 5 or 5.5%. And to give you an idea what a mortgage stress test is basically the lender needs to calculate that the rent will cover the mortgage payment plus additional for sort of tax, void periods, expenses, and not at sort of today's interest rates, maybe an interest rate in the future that might be higher. And if it still washes its face, generally they will lend. And because the interest rates were so high, the lenders were having to stress test, rates even higher than that. And we was often finding difficulties to mortgage properties that were low yielding, so high value properties where the rents were, fairly low in comparison. Especially in Scotland just now, we've got a rent freeze as well, so that's kind of been adding to that problem. But as rates have been coming down, and as the lenders are starting to get grips of kind of the mortgage market and the way it now is compared to before, we've seen a lot of lenders reduce these stress tests. Some are still stressing at the old rates, some are stress testing at the lender's pay rate, which is the rate that you pay over that initial period, and others have like a pay rate plus a percentage. So, and depending on which product you're taking, generally there's kind of different calculations. So there's a few ways that you can potentially sort of stress test the properties, and some are more favorable than others. We've seen variable tracker and discount rate mortgages become a lot more popular recently, especially after the mini budget, where the fixed rate mortgages became a lot more expensive. This has changed recently, where the fixed rate mortgages have started to come back down again. However, with the base rate now at 3.5%, some of these variable tracker and discount rate mortgages are obviously a lot higher. So generally, for a tracker rate mortgage, you'll be tracking the base rate plus a percentage. A discount rate mortgage will typically be a discount on the lender's variable rate, which usually, not always though, kind of falls in line with the base rate to a certain degree as well. But the difference between the two isn't as much anymore. So it's still worth looking at these products. They offer a lot more flexibility. And if the base rate goes up, obviously your rates will go up. On the flip side, if the rates go back down, then your mortgage product will also go back down. Some don't have any exit fees either, so you can potentially remortgage to another lender. So it's giving you that flexibility. Others still do have exit fees, but the exit fees typically are lower than a fixed rate mortgage. And now a lot of lenders are also offering what's called a switch to fix or a track to fix as well. So if you are taking one of these variable track rate mortgages out, they're allowing you to move on to a fixed rate mortgage with that same lender within that initial period, and they waive their exit fees that you typically need to pay normally. The good thing about this is it gives you that flexibility, especially if the base rate continues to rise and you're just a bit worried about your payments getting too high, or you want that stability of a fixed rate mortgage, you're able to move on to that product. So it is a good option that they're now offering. A problem that we had last year was, especially with how busy the property market was, lenders were just struggling to cope with the amount of applications that were getting in. And one of the ways for them to slow down the amount of applications was to increase interest rates, because the higher the rates are, the less likely they're bound to get more applications. So the good news is just now a lot of the lenders have slowed down. A lot of the specialist lenders even are kind of looking at sort of 1 day turnaround to look at applications, compared to in sort of the peak season of last year, somewhere up to kind of 30 or 30 plus working days to assess applications. So it just shows you how much, how, different things have changed kind of over the last sort of 6 months in particular. I think for us, the good thing is obviously, especially if you're buying a property, potentially the case will go through a lot quicker than it has previously. On remortgages, the same applies as well. But also, just kind of what I said earlier on about the rates. So, like, the lenders are starting to kind of drop their rates back down now. They want to be a bit more competitive. They want to get more applications in. So the fact that they aren't busy is a good sign for us as property investors, because ultimately the lenders do want to lend. Another thing to keep an eye on just now is, the lenders' view on the Scottish market. So a lot of lenders are looking at what's happening here. We've got the holiday let licensing laws coming into effect soon, although that's been delayed again for a further 6 months. We've got rent freeze in place just now, and there's talks of that potentially being extended again as well. Also an eviction freeze too. We've now got the ADS at 6% rather than 4%. So it's quite different to the English and Wales market. So, and the lenders are looking at this as well. We've had some lenders restrict their LTVs, not by much, just by about 5% in the Scottish market. Other lenders are just keeping an eye on the market and saying that, well, if the rent freeze continues, we might ask that landlords have a buffer there just to cover, especially with the eviction ban as well, just to cover any void periods and that sort of thing. So something to keep an eye out on, that potentially they might start to kind of have different criteria for Scottish clients than they do for English clients, especially if some of these rules are extended. A quite common question just now is that I'm remortgaging. What should I do? And obviously, it really depends on your personal circumstances. Generally, most lenders are offering their existing clients better products than they are for new clients. And this was definitely the case a couple of months ago, has changed a little bit recently and has become a bit more competitive. But if you're not looking to kind of change the terms of your mortgage, borrow any additional funds, that sort of stuff, then a lot of the times it is, the lender themselves that you're with at the moment is offering, and that's if they do offer that. It's what it's called a product transfer. You can move on to a new product with them. There's typically no underwriting involved. They'll do like a desktop valuation of your property, and if you're happy with that, then you can just move on to a new product with them. And for us, for our clients, what we're doing is we're doing kind of side by side comparison. This is what your current lender will offer you. This is what another lender will offer you. And then you can decide from there what's the best option. But I think kind of the biggest tip I'd also give you is that if you are remortgaging, look at it as soon as you can. So have a look at all your end dates on your mortgages, and ideally you want to be looking at this at least 6 months prior to your end date, and that just gives you more options really. Some lenders have a product transfer window of up to 6 months. So you can actually look at what products are available up to 6 months in advance. The advantage of that is obviously you can see, especially if interest rates are rising, you can potentially lock into a better product. Many lenders are also allowing you to lock that product in, but if a better product does come along, then you can change to that better product as well. So that's again another thing that we're doing just now. We're getting emails constantly from the lenders what the new products are, and then we're just able to move the clients onto that better product if they're eligible for that. On the flip side, if rates are starting to go up, you've at least locked in that product, and then the new products at the higher rate don't apply to you. And again, on the remortgaging, if you are remortgaging and going to another lender, doing it up to sort of 6 months advance, depending on the lender. Some lenders do offer you like 6 month mortgage offers. So once the mortgage offer comes through, you basically don't need to redeem it straight away. You can redeem it once your current mortgage finishes, but that way you've got the rate locked in. And again, a lot of the lenders are allowing us to move clients onto a better product if a better product is available, which is definitely happening just now. Some predictions for 2023. I definitely think that the property market is going to be a lot slower. We've definitely seen a drop in the amount of purchase applications that are going through, and I think, like I said earlier on, that the lenders are very keen to lend. A big problem, especially in Scotland, that we've had is that a lot of lenders aren't lending on lower value properties. I think we're going to see more lenders drop their minimum loan sizes, come back to sort of the 75,000 k sort of property valuation, maybe even 50,000 property valuation, which would be great because there's a lot of great investment properties in that sort of 50 to 75,000 range. And especially in limited company, there's not that many lending options available just now. I think those start to become a bit more flexible with the criteria. So things that they might not have offered before, they will start to offer. I know a lot of lenders are looking at offering bridging finance, so just kind of extending their suite of products that they've got available, holiday let mortgages, especially with kind of the interest rates going up. A lot of clients are looking at more short-term lets, holiday lets, that sort of thing. So I think a lot more lenders are going to offer those products too. Bridge to lets as well. So especially if the lender's going to offer a bridging finance option, they'll maybe offer like what they call like a bridge to let, where you can take short-term finance with that lender and then move on to buy to let mortgage once you've kind of done the works that need to be done to make that property lettable. So overall, in the mortgage market, I'm quite positive. I think this will help us as property investors when we are buying in a market that will be quite different to 2022. I'm sure there's going to be some challenges. For me personally, as a property investor, I'm quite excited about 2023. I'm seeing the slowdown in the property market as an opportunity. I've found it quite difficult to buy properties over the last couple of years because the property market has been so buoyant in my local area. People have been willing to pay way over the market value for properties. And with that slowdown now, I'm starting to see deals become available. Estate agents starting to contact us again. We've seen fixed price mortgages, purchases, sorry, asking price. We're seeing some people kind of willing to accept a discount as well. A lot of my clients are now buying properties below the home report values, and in certain areas where typically before they're having to pay 10, 20% over. So although you might be paying more on your mortgage payments, if you can save on the front end when you're buying, that can help offset some of the costs. Rental demand is definitely through the roof in my local area, pretty much across the whole of Scotland. Speaking to all my clients, it's definitely a problem. There's a shortage of rental properties. With some of these new regulations that come into place, there's going to be some landlords that can exit the market as well, which will just make that problem even worse. So yeah, and we're seeing because of that, because of the supply and demand, we're seeing rents going up, and again, that's also helping us offset some of the issues that we're having. So guys, that was just kind of a quick tour in the sort of the property market. Just give you an update. You feel free to leave me any comments on here. I'll answer any questions that you have. Otherwise, you can reach me directly. You can book in a strategy call with me, a discovery call, or I can answer any questions that you have. Thanks for watching today, and take care. Bye bye.